Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today I want to talk about how some traders will use an income strategy in an effort to actually try to buy stock shares at lower prices. You know, the old buy low and then sell high. Well, sometimes it starts by selling a put. We're going to be talking about how traders might do that, how it sometimes works, sometimes it doesn't. We need to talk about both sides of things, but a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. As always, great to see all the familiar names and a few new ones. That's always nice. But hello there, BJ and Alfie, Rojo, Eva, Greg, user LK8KU2GT80, Debbie, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you are here for the very first time, though, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the presentation. The recordings are a great way to watch these webcasts, but if you'd like to join us here in the live stream audience, this is a Monday webcast series. We kick things off promptly at 2 Eastern time. Love to have you here in the live stream audience. And for my live stream audience members, we have a treat here. My very good friend Barb Armstrong is joining us in the chats. She's going to be addressing any questions that I can't get to that come into the chats. If I can't address them, Barb's going to be there to pick up my slack. Thanks for being there, Barb. Barb and I would also like to issue an invitation to everybody listening to please do follow your favorite Schwab presenters on social media. You can find Barb and me on X. You find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. Now, as of very recently, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you to my profile and you can give me a follow there. But let's get into this discussion using an income strategy as an acquisition channel for stock shares. Sounds a little bit weird, but yep, some traders do exactly that. But before we can discuss that, of course, there are risks associated with this approach to trading or investing, as there is with just about any approach to trading and investing. So bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set an agenda for today's discussion. This webcast is a part of an ongoing series of webcasts, so we already have some trades in place. We're going to go look at those example trades, see how they're coming along. I think there's one that needs some particular attention today. Then we're going to take a quick peek at the markets to see what conditions an income investor or trader might be engaging in, since this series is all about income. Then we're going to be talking about using one of those income strategies, selling puts, as a potential acquisition channel for buying shares of stock and hopefully at lower prices. So we'll talk about how we might set a trade up, how it might work out and accomplish that objective, how it might fail and expose that trader to risk, and how a trader might manage those sorts of potential outcomes. So let's go to it. Let's go have a look at the at our current positions. Right now we have 6. Wait a minute, we had 8 last week. What happened? Actually, 2 of our trades concluded between last week and this week, so we'll look to see what happened with those. But let's start with the current ones first. So we have AbbVie, ABBV. This is a covered call. We own 200 shares, purchased at $227. They're up a little bit, $227.18 up to $227.93. Now, at the same time, we sold 2 contracts, obligating us to maybe have to sell those shares for $240. Sold that contract or those contracts for $211. They're now at $137. This trade's actually doing just fine, up an unrealized profit of $300 right now. But let's go look at it on a chart. So here was our trade. This was last week's trade. Took an entry right there, 227.18. We sold a call or our calls up here at 240, so we're still some distance below that. The trader here might have a preference for the stock to go up, and if they want to retain ownership of shares, maybe stay just below 240 as we move toward that January expiration. It's kind of what we're getting right now. We're up a little bit. So nothing really to be done here. we have a plan here. If support breaks, we might think about closing out if we slip down here below 220, but we haven't done that. So let's let that one go. Next up, we have Amazon. This is a short put position. Sold the 215 puts for the 16th of January. We sold those for $370. They're only worth $1.50 right now. So if the objective is to just see this expire worthless and retain that contract value, that's what's working. So let's go see what's going on with Amazon. When we sell a put, it really is a bullish trade. And we sold these puts here, and the stock has been up, it's been down, it's kind of back up and pretty much where we started things, but time decay is really starting to help out this trade. We're more than halfway to the maximum gain, the theoretical maximum gain of this trade. And we have the plan here. If we get assigned, which is more likely if the stock were to fall down below the strike of 215, maybe we'll start to sell calls. If we don't get assigned, well, maybe we'll move on to another stock or possibly sell another put here, but that one's doing just fine. So up about 300 on the first trade, up about 440 on the second one. Our Alphabet position, we just own 100 shares of stock, and this webcast series is not called stock trading. It's called covered calls and short puts, trading covered calls and short puts. This was a covered call. We bought some shares a long time ago at 199, and then just recently we sold a call, and that contract is now expired. So here's the Google trade, and this is the one that I think maybe we do something with it today. So we bought the shares way back here. Right here, we sold the 19th of December 315 calls. Those have expired now because it's the 22nd of December as of the recording of this webcast. Those contracts expired worthless right there. However, what's the stock doing? Well, it still appears to be in an upward trend. We had a potential support right there at previous resistance, a previous price ceiling. What do you know? Just as we might have hoped, seems to be acting as a new support. So for the shares, that's great. They continue to rise. What I think we might do here, let me change the properties, right click and edit the properties of that first line representing the contracts that have expired. What if we were to look here? Let's put ourselves in the shoes of a shareholder who owns shares that have been appreciating nicely, and maybe they want to provide some upside potential for that to continue. Looks like recent highs are around 325. Let's draw that in here. 325 is going to be around there. I'm going to be a little bit more precise. Right click, edit the properties here. Let's make our line right at starting and ending at 325. Click OK. So there's 325 right up at previous highs. So let's sell a call up there. So if the stock continues to rise, well, we'll have an obligation to sell if it's able to push through that ceiling. All right. So let's go see what we can maybe get for Alphabet for the 16th of January contracts. Not always, you notice I'm sort of just going by default to the next, to the third Friday of the next expiration cycle. Not everybody does that. We could look at weeklies, we could go further out. There are pros and cons to doing that. But let's just say this trader thinks they don't want to cap their upside for very long. And maybe they're sticking with these monthly expirations because they tend to have a little bit stronger liquidity than typical weeklies. All right, but let's go to the trade tab. Let's look at, was it 325? I think that's right. And it looks like that those contracts are trading close to $3. We've already realized a gain of 277, so pretty much like the last trade. And let's click on, it was 325, wasn't it? Yeah, 325. Let's go to 325. I'm going to click on the bid price. And one other thing I need to triple check is we just have 100 shares, right? Yep, have 100 shares. So let's make sure we just sell one contract. So let's go to 325. I'm going to click on that bid price. That'll create an order to sell 10 contracts, but we only want to sell one. Right now, mid is about 293. The natural is about 290. Let's say we're willing to sell for 290. I'm going to lock that in as our limit. And let's click confirm and send. Looking to sell the 16th of January 325 call for at least 290. That's our limit. We might not get 290. We're trying to get it. If we do, there will be a commission charge, so chip away a little bit at that minimum acceptable credit. So we're saying the least we're willing to accept net of commissions, $289.35. Let's send that order off and see if we can get that filled. And we did. All right, sold it at $290. Exactly. So what that means is that through that next expiration cycle, the third Friday of January 16th, someone has the right to buy our shares from us for $325. Yeah, the same shares that we previously purchased for $199.15. So if we get called out, that would be a realized gain on the shares of over $125. Let's see, JR99 says, can one place a covered call on a long stock if you already have a stop loss set? That's a very good question. And the answer is in some accounts, no. Yeah, wouldn't be allowed to do that if we have that, let's say that trades in an IRA, because we can't have an order to sell in two different places, wind up potentially selling the stock shares twice, winding up in a short stock position, which has unlimited risk potential, and unlimited risk is not allowed in an IRA. So yeah, we might want to think about canceling the stop order. We can then reinsert a stop order that closes out the contract first and then sells the stock. Okay, we could do that. That would be allowed. All right, let's see. Mark says the Alphabet stock could be impacted by the Intersect deal. I know they own part of them already, but apparently this is an all-cash deal. JDLMI says, doesn't it cancel the stop order? No, it doesn't. No, it'll just reject the order in an IRA. Good question. Mark, I'd have to read about that deal. Anyway, that's it for this trade. That was the one that I think we needed to do something with. On to our Microsoft position. This is another short put. This is a long-term short put. We sold way out of the money. 760 days till expiration. We sold the 380 put on a stock that's trading at over $480. So here's that trade. So our stock's way up here, and we sold a put way down here. What we're hoping for, the trader's probably just hoping for the stock to move up sometime in the next 2 years in this case, putting these puts further out of the money and hopefully allowing us to buy them back at a lower price. That actually hasn't developed yet. The stock has actually done the opposite of that. It's actually come down a little bit more. So we're a little bit underwater on this trade right now. That's our one unprofitable trade. This one looks unprofitable. And I had a little back and forth in the YouTube comments with somebody because this trade is not unprofitable. There are actually already realized profits on this NVIDIA trade. But yeah, Microsoft, we're going to let that one continue to work. Still 2 years, sorry, till expiration. We're going to let that one go. NVIDIA is the one where I said, yeah, hey, looks like our profit or loss since we opened the trade is underwater. However, overall, if we look at the entire sequence of trades we've placed on NVIDIA, we're actually making money on this. So how can I say that so confident? How does my compliance team not flag me and say, Cameron, you were wrong? Because I'm right. We bought some shares, bought those shares at 183. We're a little bit under on those. 183.71 is what we paid. 183.08 is what they're worth. That's not a profit. We sold a call for 193. If we were to try to buy it back right now, we'd have to spend more money to get out of it. That's not a profit. So we're net losing on both sides. Ah, it's a tragedy. Losing $92 as of this moment, unrealized losses on our covered call. Well, yeah, that's the current covered call, but we've owned these NVIDIA shares for a while. And since we bought them, we've already realized gains on 2 other calls. So we're down $92 on the current trade, but we've already made, what is it, $500 or something like that? Let's go look at our NVIDIA history here. So that's where we bought the shares. This is where the shares are right now. So you can see the shares are awash. Here's where we sold that call. The stock's been going up. That doesn't help trying to get out of short calls. However, previously we sold a 14th of November call and realized a profit of $3.40. We sold a 19th of December call and realized a $3.43 profit. So there's actually $6.83 between the two. or nearly $700 of realized profit. Obviously, these are paper money trades, but what we're doing, we're mimicking the experience of actual trading. And in this case, $700, $683 of realized gain set against $92 of unrealized loss. We are still well above water on this trade. That's what I mean. I wanted to clarify that because somebody commented on that, because I mentioned it last week, said, hey, we're above water. How are you above water? Your PL Open says you're underwater. The PL Open only tells the story of the current position. It doesn't show the entire history. And you might think that's a shortcoming of the platform. It's not. Your bank account only shows you how much cash you have right now. It doesn't show you how much cash you had last week. You go to your account statement for that. You can do that on Thinkorswim as well. So, yep, it's working properly. All right, but this actually, the trader here is hoping the stock goes up because that helps out the share ownership, but they might also simultaneously be hoping that we stay below 195, and we're still below 195. So that one, I'm going to also allow that one to continue to work. Which brings us to finally XOM. So XOM, we have a covered call, bought the shares, they're slightly profitable, sold a call, it's slightly profitable, net up about 200 bucks at the moment. Our preference here is for the stock to go up, but to stay below the 120 strike, and we're at 118. So actually that's cooperating just fine. XOM, there's our strike. We're going to let the stock see if we can continue working toward that 120. But we do have a plan. If the stock starts to misbehave, we're the shareholders, we might exit this if we break support. So those are the current positions. But we had two others when we last convened a week ago to record my last webcast. Those two others, Bank of America and Apple, are done. So let's see what's going on with Bank of America. This is where we could go to our account statement, by the way. And if we look over, looking over the last 8 days might not reveal what happened because we've had one expire and one assign. So let's go to our charts and I'll show you what happened. So here's Bank of America, bought 200 shares at $50.58, sold a call, it expired, we made a profit. Sold another call, it expired, we made another profit. Sold a third call, it got assigned. So we agreed someone else could buy our shares for $54, and they did. So we bought the shares for $50.58, sold those shares for $54. That's a $3.42 profit on the shares. And we kept the 47 cents collected from that third contract, and that added to the others means this has been a pretty good trade overall. We've been assigned. That trade is done. Our break even, having sold those contracts, kept getting lower and lower and lower. Our break even was down here at 47.77. Doesn't matter now because trade's over. So now if the stock keeps going, maybe an owner of a couple hundred shares might wish they still owned those shares, but that's the benefit of hindsight. We're just going to wrap this one up. It's done. That brings me to our final trade, which also ties nicely into the theme that I wanted to have for today, which was a put that we sold on Apple that has expired. So here's our Apple trade. We saw that Apple had been running up and pulling back and running up and pulling back and running up and pulling back. It was just sort of stair-stepping higher. Looked like it had set up a pretty decent potential price floor around 265. So we sold the 265 puts right here where this blue oval is. That's when we did this trade. Sold those puts with the hope that maybe they just expire worthless. The stock went up, the stock pulled back, we hit expiration, still above 265. Those contracts did expire worthless for a 277 profit. All right, so that's a trade nicely concluded, but sometimes though, rather than desiring to have the contracts just expire worthless, some traders might actually prefer for assignment when they're selling puts. They may actually be using it in an effort to buy shares at a lower price. So I want to do that again today. So here we are today. Let's put an oval around our new trade day. Let's say that our trader, our would-be owner of Apple shares, is thinking, boy, Sure would be nice to own some Apple shares because they've had this really nice run. And if that run continues, maybe there's more upside potential on those on share ownership. But they might look at in the short term, the stock has been pulling back. And they're worried maybe that momentum is going to carry us on down to previous price floors, possibly at 265. And thinking of this advice they've had in the past, have you ever heard somebody say buy low and then sell high? Well, maybe they want to buy low. And for their definition, maybe 265 is what they consider to be low. It's lower than today, where we're still trading at 270. So I want to set up a trade as an example for today where the trader is making an effort to buy shares at a lower price. Now, obviously, we could just put in a limit order of 265, set it good till canceled, and then see if the stock gets down there. That's one thing that a trader can do, but there's no potential benefit in the meantime. So here, yeah, Mark says we're discount hunting. Exactly. Yep. Now, it's going to sound like, ooh, this is the flawless strategy, Cameron. No strategy is flawless. We need to talk about the pros and the cons of a potential approach. But here's what we're going to do today. I'm going to go to our scratch pad. Let's widen this thing out a little bit so I can outline the plan for today. But I'm going to go to the trade tab, and let's say, actually, as we do that, let's draw in a line starting today at 265. Well, I'll just draw it right about here, out to January expiration, right there. I'm going to right click on that, edit its properties, make it exactly 265. I'm going to change that color scheming to red, but there we go. There's our line at 265. This is where the trader is attempting to purchase the shares. All right. So here's how they're going to try to get that done. I'm going to go to the trade tab, and instead of buying the stock right now, which we might do, maybe what we ought to do is do a comparison. Day one, that's today, to January 16th. Okay. So we could do, let's say, we'll call this trade A. Buy shares on day one at whatever the current price is, 270.85. All right. Could do that. But this trader thinks the stock is likely to go down to 265. So buying at almost 271 in their mind might be exposing themselves to $6 of risk. So instead, they consider trade B, which is not to buy the shares, but to get into a contract to buy the shares, but not at today's prices, at a lower price. We're going to do this. Sell the 16th of January, 265 put. Now, when we sell contracts, it actually creates a credit for the account. It's a collection of a premium. So yes, another trader is theoretically paying us for this deal. So right now that's trading between 271, 274. Let's say that we're able to collect $2.72 for this trade right now. So if I were to phrase this one way, an extremely optimistic way, this is the way if I were trying to sell the strategy, which I'm not, but if I were, I would say, look at this. Another trader is paying us for the privilege of buying the shares for $265, which is $6 less than those shares are worth right now. We're getting paid to buy the shares at a lower price. Well, that's true compared to day one, but we got to deal with the positive and the negative here. And anytime we start to hear something that sounds like a sales pitch, it probably is somebody that has something to sell. I don't have anything to sell to you guys. I'm an educator. So let's look at this through a balanced lens. All right. But this is the deal. We are going to sell that put. So I'm going to do it right now. Let's go to the 265 put, and I'm going to see what we can get for it, and then I'll update this. Okay. So I'm going to click on this put, and how about we do this? Should we do one yeah, let's just do one contract, just to keep the math really straightforward. We're going to obligate ourselves to maybe buy some shares at 265 bucks. So I'm going to click on the bid price to create that put sell order. let's just do one contract. So it's just a contractual obligation to maybe have to buy 200 or 100 shares at 265, but it's for the 16th of January, 265 put, and might not be able to get 272 or whatever I had there. Let's say 269. I'm going to set that as our limit right now. Prices are moving as we're talking, but let's click confirm and send. Going to sell that put, trying for a 269 limit. If we collect that, we chip out 65 cents for the payment of the commission, so it leaves us a minimum net acceptable credit of 268.35. Let's send that order off. And it immediately filled for 270. So here's the real deal. We were talking in hypotheticals. It's no longer hypothetical, it's real in paper money. So this is what we just did. We sold that 265 put for $2.70. So what has just actually happened? RT, yeah, I saw you ask this question earlier, RJTIOBY. Do you consider, or might a trader consider, because what I consider in my trading has nothing to do with what my audience should do with their trading, because I'm not an advisor, right? Anyway, but might a trader consider implied volatility before selling the put? What does implied volatility tell us? Well, there's a strong relationship between the pricing of options and implied volatility levels, or just volatility levels in general. When volatility is high, options tend to be pricier. Now that sounds good. Oh, good, higher prices. Yeah, but because volatility is high, volatility can be risky. So there are pros and cons. So for some traders, they might check, for example, down at the bottom of the options chain. In today's option statistics, we can see a range that IV, known as implied volatility, has ranged between about 70 and 19. Now, right now, our implied volatility is at 21. Is that closer to 70 or 19? It's actually much closer to the lows than the highs. So what this is telling us is that volatility is low right now. So premiums aren't very high, which doesn't sound very good. Well, that's because the markets are less choppy. It's theoretically a less risky time to be selling puts, and therefore they don't pay as much. So there are pros and cons to that. Volatility can increase the premium, which is good, except that volatility typically is associated with higher risk, which is bad. So there you go. So Jeff C says, sell options on high volatility if we like selling when volatility is high. Are we okay with the increased risk in pursuit of a higher premium? If yes, then yes. If we're not okay with the high premium because of concern about the risk, then maybe no. Yeah, so there are pros and cons. So it's a good question. Not every trader checks the implied volatility, but that is a question that had come up earlier, and I didn't get a really good chance to address it, so now I've addressed it. Okay, so, but we need to look at the reality of what we've just done. Whether we just got a big premium or a little premium, we've got a premium. We were paid $270, yes, and in exchange, we now have an obligation entirely in someone else's control. We are not in control of the vehicle anymore. Someone else has the right at any time, whether on the whim or at some logical moment, but at any time, they have the right to sell shares to us for $265. Well, that sounds like, well, that's dramatic. Now it's sounding kind of spooky. Well, it is an obligation. So let's talk about how this might work out for the trader who is looking to buy at lower prices, how that might be a good thing. It might not be a good thing. So, under what circumstances might someone who has the right to sell his shares for $265 actually choose to assign that right? Well, it would be if the stock goes down in price most of the time. Now, they could do it right now if they wanted to. It's just not very likely because mathematically it doesn't make a lot of sense. They could. But from here, day one, to here, so this is January 16th, that's when our contracts expire, what might happen? Well, the stock could go down. What if we go down here? Let's be kind of optimistic here. All right. Let's play the perfect outcome scenario. Let's say we wind up, boom, right there. Did you see where my cursor was? The end of that line is 264.92. Or in other words, what if price goes just below 265 and this contract expires in the money? Here's what happens at expiration with almost no exceptions. If the shares are worth 264.92, in other words, the shares are worth less on the open market than the shares are worth according to this deal. Someone has the right to sell us shares at more than they're worth. Are they going to do it? Yes, they're going to do it, with very rare exceptions. It happens automatically, as a matter of fact. Unless they've left explicit instructions with their broker not to do this, the brokerage firm is going to do it on their behalf if they don't do it before expiration on their own. So yeah, if the stock is below 265, the contract gets assigned and the shares are sold to us for 265. In this case, that may be the accomplishment of exactly what this trader set out to do. Awesome. I now own the shares at 265. Tell me this. Answer this question for me. Is it better to have purchased the shares at 265 or at 271 if they're right now worth right around 265? Well, obviously, we've gained an advantage here. Bought the shares at a lower price, and we can now say we were paid for the privilege because we also collected 270 up front, and that premium is now a realized gain at expiration, or at any moment if the contract is assigned, that premium becomes a realized gain. The other trader doesn't get the chance to reach into our pocket, pull the 270 back because they regret doing the deal. All right? Yeah, Ted. Ted says that's like a net cost of 270, 230. Exactly. What would be the, not two, let's do the, redo the math, 260, 230. You're on the right path there, Ted. I make those mistakes all the time too, so I forgive you. But yes, where would our break even be for this new trade? This one's for the other one. That's for the trade that's already done, 260, 223, 260, 230. Close enough. Yeah, break even is actually down here, but that's important. Let's draw that in. Let's actually update this. You know, I like that being there because it keeps the history of the trade. I'm going to leave that on there. But for the new trade, just imagine our break even is there at 260, 230. This is still a helpful visual. All right. Why is that important to know? Well, because if this happens, the scenario changes. Let's say the stock starts to kind of crash. This isn't looking like such a sexy trade anymore. The person that was saying, ooh, you get paid to buy the stock at a lower price, this is the chapter they left out of their book. All right. What if the stock starts to fall a little bit harder? What if it comes down here and we're at 255 at expiration and we're obligated to buy it at 265? Now we're overpaying for the shares by 10 bucks. Now, for that privilege, yes, we got paid $2.70, but if we're $10 underwater on the shares and we got $2.70 to help us feel better about this deal in the form of a realized gain on a put that we sold, do we really feel all that good? Because according to my math, that's a $7.30 unrealized loss at the moment of assignment. That's not so good. I will say, though, it feels a lot better than maybe that trader who just bought the shares right here on day one. Because if they bought the shares at 271 and they watched those shares fall down to 255, they're looking at a $16 unrealized loss, right? 16 bucks versus $7.30. We still feel pretty good about this. So this could still be a positive story for our put seller. Wow, this is better than buying stock in all scenarios, right? No, it's not. In these scenarios, it has been. Under what circumstances might this not be an optimized outcome? Well, sometimes the shares don't go down, and they might decide to just blast off. Let's talk about a final potential scenario. So maybe the stock doesn't go down, maybe it does go down, or maybe it starts to just rocket on up. Let's say the shares are up here at 290 at expiration, January 16th. The shares are already up fairly dramatically. And we're thinking, oh, good. because I get the right to buy the shares for 265. Might want to chalk that up as a possible pipe dream at this moment. Because if the shares are worth 290, even though someone has the right to sell them to us for 265, are they going to do it? No, they're not going to do it. Very, very, very rare exceptions to that. So they say, Cameron, keep my 270. I'm keeping the shares that are now worth 290. I'm not going to sell them to you for 265. And now we look at this and we think, oh, so what actually happened is I collected a small income and I got left on the side of the road while the other person who decided to buy the shares for 271, now they're sitting on a $19 unrealized gain. So selling puts for income in an effort to buy shares at a lower price can actually sometimes leave the trader on the curb staring at this pocket change that they've collected relative to the upside potential of the stock. So is it a perfect strategy? No. And actually, for this trader, even if they didn't get to participate in the shares going dramatically upward, $2.70, it's not, that's not something to sniff at. That's still about a 1% return over the course of a month. That's not necessarily a bad return. It's not as good as our hypothetical where we went up $19. But this is the more complete story of selling puts in an effort to buy shares at a lower price. It might work. If the stock goes sideways, if the stock goes down, it's probably better than just buying shares on day one. But if the stock takes off, it might not offer as much potential. All right. But we're going to do this. We're going to do this trade. Let's take off this drawing because we don't know the future. This drawing. Let's remove this one. Let's remove this one. And we've sold this contract for 270. So I'm just going to make a note here on our screen. Right here today, we sold the 16th of January, 265 puts. It was just a put for, what did we collect for it? 270. It's right there on your screen. It's right there on my screen. It's a reminder to me. I click OK. I just changed this to a red to indicate that I've sold something. Red doesn't mean good or bad to me. In this case, it's just, did I buy or did I sell to initiate the trade? So we sold the 16th of January put. So what is the preference for the trader from here? Well, if they want the shares, the preference might be for the stock to fall down to their support level, but not to penetrate it too far. If the stock rallies, oh well, at least they collected 270, and that might just be a consolation prize on an otherwise missed opportunity. So we're going to let this one work. That's our new trade, guys, but we have accomplished what I set out to do today. I wanted to talk through this scenario of getting paid to buy the stock at a lower price. Yep, it's true, we're getting paid a premium, but it comes with obligations. The obligation is to buy at 265. If we wind up buying the shares at 265, well, net, that's a better price than having bought on day one, but there's still risk exposure if the stock falls hard after that. All right, so we need to understand the pros and the cons of our strategies. So we'll see. We'll see if we just see this premium evaporate to nothingness and we just see it expire out of the money and 270 becomes the profit for the trade. Or we'll see if we wind up getting assigned the shares, unlike this last time where we didn't get assigned the shares. If we do get assigned, maybe we'll look at selling covered calls on that new share ownership. JDLMI, you like that? Good. All right, David, my pleasure. Everybody, thanks for giving me your time today. Barb, thanks for helping out in the chats. I was keeping an eye out, didn't see a survey that had come in, so I won't ask you to fill out a survey today because there isn't one, but when there is one, please do take the time to fill that out. Barb and I do want to make sure that you're aware of the full slate of educational offerings available to you from Schwab Education. One big deal is, first of all, if you're new to this, make sure that you have subscribed to our Trader Talks channel on YouTube. So our channel name is Trader Talks Schwab Coaching Webcasts. This is where you can join these live streams. You can also find the playlist for previous webcasts. So like if you didn't see me plan in place that AbbVie trade that we talked about today. That was done in the last webcast. So if I go to playlists and I scroll down through all of our different webcast series, right here is our trading covered calls and short puts playlist, and I can view the whole thing by clicking on view full playlist. And then I'll be able to see last week's discussion. Scan for covered call setups with Thinkorswim Stock Hacker. You can also see all the other topics that we've covered in this series in the past. You can see the logic of the trades that we've placed in addition to our AbbVie trade. Now, another thing that, oh, and by the way, so you just go down and click on the subscribe button. Literally takes a second, doesn't cost anything. But another thing that Barb and I would strongly encourage you to do is to follow us on social media. Barb is very active on X, and so am I. I actually just scheduled a new thing to be published tomorrow. I'm going to be releasing a new video tomorrow. But you can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. And if you reply to one of my posts on X, I just reply right back to you. It allows for some very nice interaction. It's not otherwise available if the camera's not on. However, as of about 6 or 7 weeks ago now, you can also follow me on LinkedIn. Just go to linkedin.com/in and then throw on /Cameron May CS. That'll take you to my LinkedIn profile, and just give me a follow right there. So you'll notice, yeah, I have over 17,000 followers on X. I've been on there for years. I only have 158 followers on LinkedIn because I've only been on here for a few weeks, but I make posts here on LinkedIn as well. As a matter of fact, I do longer posts on LinkedIn because I don't have character limits. So that's kind of nice. And if you reply to me here, I reply right back to you as well. But guys, thanks for giving me your time today. I'm going to let you go enjoy our other webcast offerings. I will look for you in one of my future webcasts. I'll also look for you on X and on LinkedIn. Actually, before I sign off, I also want to say thank you for all the thumbs up. I can see 131 people watching a live stream right now. And as I refresh my screen, my browser, I can see 43 have already clicked the thumbs up. That is also always appreciated because it's a really nice digital pat on the back for your presenter, but it also gives my webcasts a boost in the YouTube algorithm. It sends a signal to YouTube, hey, I liked this webcast, show it to other people, and then YouTube promotes it to more people. They find these discussions about things like trying to buy stocks at lower prices by selling puts, the pros and the cons of those kinds of strategies. So thanks, guys. Definitely appreciated. All right, go enjoy your day. I'll look for you in a future webcast. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.